recession is going to be worse than analysts expect, and the bottom is going to be lower than analysts expect. And then on top of that, possibly global financial liquidity crisis worse than 2008.
In a dire warning, Jim Rickards predicts that most people will lose everything as the global economy teeters on the brink of a severe recession.
And this is going to be part of what throws the economy into a severe recession. So with the economy going into a recession on its own, with a global liquidity crisis brewing, why on earth is the Fed raising rates at all?
The global economic landscape, once robust with a 10% compound growth, is now faltering, amplifying concerns of a widespread economic downturn.
So the global economy is in bad shape. It's going into a recession. Now, a lot of people have said that, we're going to have a recession as if it's no big deal, but they're expecting a mild recession.
Jim Rickards points out the unusual dynamics of cost push rather than demand pull, signaling a potential recession as the U.S. economy grapples with shifting forces.
The global economy is weakening very quickly. That's backed up by a lot of metrics. Most recent data out of China indicates they're on the brink of a recession, if not in a recession, which is kind of shocking considering this was an economy that grew at 10% compound rate for about 30 years.
From the Nasdaq's decline since January 1st, 2022, to the broader economic downturn starting in November 2021, signs of trouble loom large in the financial landscape.
But right now, we don't have demand pull, we have cost push. It will go away when this economy goes into recession. And then we're going to be talking about disinflation and deflation, which are, kind of close cousins. And the Fed's going to be out on a limb as usual, raising rates in the face of a recession and a price collapse.
As financial panic and recession converge, Jim Rickards delves into the intricate dynamics that could spell a double crisis for the global economy.
We could be looking from the current levels. Bear in mind, we're down significantly from January 1st, 2022. In the case of the Nasdaq, the turnaround actually started in November 2021. So we're down from those levels. We've kind of maybe reached some moving average, but we're nowhere near the old highs. But that it could easily go down 30%.
In response to soaring inflation, the decision to raise interest rates in July raises questions about the effectiveness of such measures amid economic challenges.
There's a brewing global liquidity crisis, a global financial crisis. Pardon me, that's different from a recession. It's financial panics and recessions are two different things. They can come separately. In 1998, we had a financial panic, but there was no recession. In 1990, we had a recession, but there was no financial panic. In 2008, we had both. They can come together. It looks like they might be coming together again. This is revealed in inverted yield curves. Major dealers are bidding at auction for treasury bills. The Fed will give you treasury bills with a phone call. All you have to do is call the Fed and do a reverse repo with the Fed. They'll give you some treasury bills. But the banks are bidding at auction for treasury bills at yields to maturity lower than what the Fed will give you for a phone call. Why would you do that? The answer is the Fed bills cannot be rehypothecated. They cannot be used as collateral, but the auction bills can. So what that tells you is there's a collateral shortage. That means deleveraging balance sheets. It means financial distress. And we also see it not just in the treasury yield curve, which is inverted from right now 6 months to 10 years, but also the euro-dollar futures curve, which is even more troubling. It's not unprecedented, but it is rare, and it's not a good sign. But the Fed continues, raising rates in the teeth of this really bad data. So I look for a severe recession in the U.S., really global, because your question was how's the global outlook? It's pretty bad. Maybe something closer to social unrest and riots in Europe.
The paradox unfolds as interest rates, initially on the rise, face a downward trajectory, sparking concerns about a potential global liquidity crisis.
Because the inflation is pretty bad. In other words, they've They've set out on a path. Also, I'm speaking about the U.S. Federal Reserve, the Federal Open Market Committee, but the ECB is right behind them. And the ECB has said they intend to raise interest rates in July. Well, that's a big deal. They haven't raised them for years, and they're not only at zero, they've been negative. So to raise them at all and go from negative to even positive, even 25 basis points, which is not a lot relative to what the Federal Reserve is trying to do, but it's kind of an earthquake in Europe. But that's all because of inflation. They're trying to snuff out inflation. So the balancing act, the question, of course, is, okay, we know that you can get inflation if you raise interest rates high enough. Paul Volcker did it. He inflation, but it was 21% interest rates. I still remember my first mortgage. I bought a condo in New York City. The mortgage was 13%, but inflation at the time was 15%. So my real cost of borrowing was -2 before tax benefits. It was more like -7 after tax benefits. So it was actually quite a good deal at 13%. But that happened. But that was part of how Paul Volcker beat inflation in the early 80s. So you can do it. But from current levels, which are over 8% in the United States, but even Japan's up around 2 or 3%, again, which is sky high for Japan. Japan's a country that's been in, we used to talk in the early 2000s about the lost decade. Well, now we're entering our fourth lost decade. They've had 30 years of very little growth. And I checked it out the other day. Since the market crash at the end of 1989, and it was a multiple market crash, it was stocks.
Exploring the intricate connection between interest rates, inflation, and their impact on the economy, Rickards paints a bleak picture of the current economic scenario.
They're raising rates and inflation's coming down. That's clear. But what they don't know is are interest rates coming down because they're raising rates, or have they already hit the terminal rate and it's coming down on its own and they just don't know it? And that's a big deal, because if they're at the terminal rate and they just don't know it and they keep tightening, which they are going to over tighten, probably already have. So that's kind of what the Fed's doing and how they think about it. Now, let's go to our next Irish storyteller. This is the market, and in particular, although here we probably have to distinguish between the stock market and the bond market. Bond market's a lot smarter. But the stock market is saying, the Fed's raising rates, inflation is coming down, but we think they're already at the terminal rate. But not only that, we think they're going to get the memo that the Fed will figure that out before they get to 5.25, before they raise rates in May, maybe even March. Maybe they're done. And because of a recession, the Fed will get the wake-up call, pivot, the famous word pivot, meaning cut rates, and that will bring the economy in for a soft landing. So this is the soft landing Goldilocks, wrong fairy tale. This is the soft landing Goldilocks scenario where the market's right, the Fed's wrong, but the Fed will realize that the market's actually right and cut rates, and if you're going to cut rates, buy stocks. That's like Wall Street always ends every analysis with buy stocks.
Amidst a supply chain breakdown contributing to inflationary pressures, the global economy grapples with the complexities of addressing fundamental weaknesses.
If everything I said is correct, and obviously I think it is, or I wouldn't be saying it, but if we're on the verge of a global liquidity crisis, as revealed by the Eurodollar futures curve and the Treasury yield curve, and negative swap spreads and Treasury bill auctions with the yield to maturity below what the Fed will give you for a phone call, all those things are happening. That's hard data, and it's a very, very troubling sign, last seen in 2008, by the way, before the Lehman Brothers meltdown. If all that's happening and the fundamental signs are also weak, which we just saw in third quarter GDP, which is based on net exports, which won't last, how are you going to drive a trade surplus with the strongest dollar in 20 years? Good luck with that. Nobody can afford our stuff, and we're not buying anybody else's stuff.
Right. Okay. And so does that imply then, if we just sort of let the system take care of itself, that CPI would get pulled down anyways by this recession?
Right, and that's a big part of my book. When I talked to my editor about this, go back a year ago, so November 2021, every headline you looked at, website, commentators, supply chains breaking down. There's no, they couldn't get cream cheese to make cheesecakes at Junior's, the world's most famous cheesecake place, and on and on and on, like a long list. And then last spring was the baby formula shortage, which was serious. I mean, mothers couldn't feed their children, so it was very bad. And I talked to my editor about the book. We said, okay, let's do it. And of course, and so I've got 3 chapters to start. One on, just anecdotal stuff, kind of thing I just mentioned. How bad is it? Chapter 2 is why. What caused it? When did it start?
Jim Rickards unravels the intricate web of challenges, from the fragility of global trade to the intricate relationship between interest rates and the prevailing inflationary storm.
There are 2 ways. You can kind of raise them very gradually and hope that inflation comes down gradually, and you kind of meet halfway. So you get interest rates up to maybe 2 or 3%, and inflation comes down from 8 to 7 to 6 to 5. That's a lot. It's still a negative interest rate. If inflation is 5 and interest rates are 3, you still have a negative 2 interest rate. So inflation will only come down when rates get high enough, but rates cannot get high enough without causing recession. So, and Larry Summers has done a good job of pointing this out empirically. It's one thing to state it as a proposition, and it's a valid proposition. It makes a lot of sense. But he looked at the data and he said there has never been a case where unemployment was this low, inflation was this high, and the Fed raised rates without causing recession. It's never happened. So a so-called hard landing. So with all that's true, and it is true empirically, historically, and analytically, all you have to do is look ahead and say, well, okay, we're going to have recession. Stocks are going to come down a lot more. Get out of stocks. You don't have to get out 100%, but get out of stocks, move into cash, move into other asset classes that will perform well and ride out the storm. The supply chain breakdown is causing a lot of the inflation we see. And we agreed on that. And then I said, I'm going to write another chapter on deflation. And everyone's like, wait a second, why are you talking about deflation? That's coming next. People are not ready for it. I know the inflation's here. I buy gasoline. I take shop in the grocery store. I get it. It's persistent. It's not transitory. I understand all that. But inflation has 2 major sources. One is the supply side, which is called cost push inflation. So that's energy price shocks, the stuff we're seeing coming out of fertilizer shortages, strategic metal shortages, component suppliers who can't deliver stuff to factories in Germany and they're shutting down, et cetera. The other cause is from the demand side, and that's called demand pull inflation. Basically, it's psychological. Consumers pull demand forward. They're like, hey, I was thinking of buying a refrigerator. I better buy it today because the price is going to go up in 6 months. And in the 70s, we had both. It started with cost push with the Arab oil embargo, but it ended up demand pull. I was starting my career at the time. Your boss would just give you a raise. You didn't even have to ask. Inflation was going up so fast. Like, I better give this guy a raise. Like, here's another, $30,000 or whatever, because people would quit. And that sort of spun out of control until Volcker squashed it all.
Wall Street's right that he's probably at or near the terminal rate already. Inflation is coming down already. It's going to come down some more. But where Wall Street is wrong is that this is going to be some kind of soft landing. This is going to be a very hard landing, a very severe recession for a lot of other reasons, including the fact that you're trying to, going back to what we said before, and this is in the book, you're trying to destroy supply inflation with demand destruction. It'd be one thing if you were Volcker and the demand is out of control and you need to crush that, but you're trying to control this inflation with this toolkit. The Fed doesn't drill for oil, they don't run farms, they don't drive trucks, they don't do anything on the supply side. So how much demand do you have to destroy?
Such a good point.
To affect the supply side?
Yeah.
So just to kind of wrap up here, but here's what's driving Powell. It's called the Volcker mistake. And if you go back to Volcker came in 1979. He immediately set out to destroy inflation, started raising rates, and he did. But we had a recession in 1980, a sharp one, that had nothing to do with Volcker monetary policy rates. Jimmy Carter put some stupid order on credit cards, and Americans put some cap on credit card interest, and Americans stopped using their credit cards. And it was like the pandemic. It was like you shut down the economy. Oh, gee, that was dumb. So they fixed it, and it went back up again. But in the middle of that, Volcker blinked. He lowered rates 7 percentage points in the middle of that 1980 recession. But inflation wasn't, and it came roaring back. And then he had to take it up to 20 to finally pull it. And I talked to Volcker about this. He said, yeah, that was a mistake. But Powell knows.
You mean the pivot? The pivot that was
that was a real 7 percentage points. And Powell knows that history, and he was around too. And he doesn't want to be that guy. He doesn't want to be the guy who blinks early. So while Wall Street's saying, hey, you got it, you're at the terminal rate, inflation's coming down, he's like, that's what they told Volcker, and Volcker pivoted, and it was a major blunder, and it was much more painful to fix it the second time than if he had just persisted in the bad.
Right now, we do not have demand pull inflation. We don't. This is not what's going on. We do have cost push inflation. The difference is hugely important because cost push inflation from the supply side, which is, again, when I talk about in the book, it's real, prices go up, but it's self-negating. The old saying that, the cure for higher oil prices is higher oil prices, because when they get too high, people stop driving. They shut down various activities. By the way, if you're unemployed, you're not buying any gasoline because you're not going anywhere. I mean, that's kind of a nasty way of putting it, but that's how cost push inflation, tips into a recession, and then prices come down.